I received a message at 3:47 a.m. Eastern Time this morning, just over an hour ago. It came from a source I have inside a major clearing firm in New York. Usually this source is calm, professional. They deal with billions of dollars in flow every day. They have seen crashes, squeezes, flash crashes, and wars. Nothing rattles them. But this morning, the tone was different. It wasn't professional, it was eerie. The message was short, just 3 lines, but it changes everything for the trading session you're about to step into. London is dark. The vault operators are home. We are completely alone on the desk. If $75 breaks today, there is no physical backstop. The EFP window is nailed shut because there is nobody on the other end of the phone. And then, at the bottom, a single line in all caps. Pray we don't gap. I stared at my phone for 10 seconds. This source has never used the word pray in a professional message. Ever. Welcome to Friday, December 26th, Boxing Day. Most of you think today is just a quiet holiday. You think the markets are sleeping off Christmas dinner. You think volume will be low and nothing will happen. You are catastrophically wrong. You're about to walk into one of the most dangerous and profitable setups I have ever seen in the silver market. This is what we call a liquidity vacuum, and it's about to swallow JP Morgan whole. In the next 12 minutes, I'm going to show you the Boxing Day trap. I will break down the math of why JP Morgan is terrified of the opening bell. I will show you the shadow margin calls hitting retail traders right now, and why the official websites won't tell you about them. I will expose the $7 arbitrage gap that proves the COMEX price is a hologram. And most importantly, I will show you exactly what to do when the market realizes the emperor has no clothes. They made a deal on Christmas morning to hold $75, but today they're fighting with one hand tied behind their back. Let's begin. Before we get to the open, we need to look at what I call the evidence board. I keep seeing comments from people saying, the price is fake, it's not moving, silver is dead. You're looking at the wrong chart. You're staring at the hologram while the real action is happening in the shadows. While London sleeps, China is wide open. And what is happening in Shanghai right now is not arbitrage. It's a panic. Let me show you the math. I'm going to put it on screen so there is zero confusion. The COMEX close from Christmas Eve was $71.69. That is the price they manipulated for you to see. That is the number the algorithms in New York are programmed to defend. But look at the Shanghai Gold Exchange. Right now, the SGE is trading silver at approximately 18,300 yuan per kilogram. Let's convert that together. 18,300 yuan per kilogram. Divide by the exchange rate, 7.25. Divide by 30 to 15 ounces per kilogram. The result, 78.51 USD per ounce. Do you see it? There's nearly $7 gap between New York and Shanghai. This is what traders call an arbitrage bomb. In a normal functioning market, this gap shouldn't exist for more than 10 seconds. Any bank with a brain should be buying every ounce in New York at $71, flying it to Shanghai on a cargo plane, and selling it for $78. They would make billions in risk-free profit. It's literally free money sitting on the table. So why aren't they? Why hasn't the gap closed? Because they can't get the silver. You cannot buy physical silver at the COMEX price of $71.69. It doesn't exist. If you try to take delivery of 1 million ounces at COMEX today, they will either settle you in cash, force majeure you, or tell you to wait 6 months. That $71 price is a ghost. It's a number on a screen backed by nothing. And today, with London closed, that ghost is about to be exorcised. Now, here's where it gets interesting. Here's the piece most people miss. Usually, London floods the market with paper contracts to hide this gap. They print paper silver to dilute the price and keep the illusion alive. London is the magician's assistant that makes the trick work. But today, the London printers are turned off. The vaults are locked. The clearing systems are offline. The British banks are eating leftover turkey. The magnet of that $78 Shanghai price is pulling on New York like a black hole. And without London to anchor it down, the COMEX price has to snap upward to meet reality. This isn't speculation. This is physics. You cannot have 2 prices for the same asset in 2 liquid markets forever. Eventually, the rubber band breaks. And when it breaks, JP Morgan is holding the wrong end of it. Now, I need to address the command center. That's you, the community. I read every single comment you write. Every question, every doubt, every piece of intel you share. And today, the comments section is a war zone. A lot of you are confused, and rightly so, about the rules change I mentioned in the last video about the Christmas trap. You're looking for official confirmations, and you aren't finding them. Look at this comment from Clay Jones 553. They didn't raise margin requirements. This is false. And another one asked, can anyone post a link to the CME group emergency limit notification? Listen to me closely. You are looking for a press release. You are looking for a billboard on the side of the highway that says, we are manipulating the market. That's not how this works. The banks do not announce their moves with trumpets and fireworks. This isn't a public margin hike plastered on the CME website. This is a shadow tightening. Let me explain how a risk desk actually works, because this is critical. The CME sets the maintenance margin, the absolute minimum cash you need to hold a position. But your broker, Interactive Brokers, TD Ameritrade, Schwab, they can set their own margin requirement higher than the exchange minimum. When they smell blood in the water, when they know volatility is coming, they don't wait for the CME to announce anything. They crank up the dial themselves to protect their own balance sheet. I have reports from users in this community who are seeing this live. Look at this comment from our Chains Joe, who checked his Interactive Brokers account this morning. Look at what he found. Initial margin for long position, March 2026 FUT, is now $46,876. That is nearly double the standard requirement. The CME didn't change the official rule on their website. The brokers changed the internal risk models. They are quietly forcing retail traders out of their positions by making it too expensive to hold. They are clearing the deck. They are shaking the tree because they want your apples before the opening bell. Why? Because they know what is coming today. They don't want you on the rocket ship when it blasts off. They want you liquidated, demoralized, and on the sidelines before the fireworks start. And I want to say this directly to those of you who got the margin call email this morning. The one that woke you up at 6 a.m. on Boxing Day. The one that made your stomach drop. Take it as a compliment. It means you are winning. It means you are a threat. It means you figured out the game and they are trying to kick you off the board before you collect your winnings. Do not let them gaslight you into thinking you made a mistake. You didn't. You are early. You are right. And they are terrified of you. And to Pirate Dude 781 who said, I would love to see them lose their homes like the people did in 2008. I hear your anger. We all do. In 2008, they drank champagne on balconies in Lower Manhattan while teachers and firefighters lost their houses. They rigged the mortgage game, crashed the economy, and then bailed themselves out with your tax dollars. They never went to jail. They got bonuses. But today, the tables are turning. JP Morgan is alone in the office today. London is closed. The vaults are locked. The physical silver they promised to deliver doesn't exist. And for the first time in 20 years, they are the ones sweating. They are the ones watching the margin meter tick up. Your turn to drink champagne. Their turn to panic. So, let's look at the battlefield for today. Why is Boxing Day specifically a trap? It comes down to volume. Because most of the Western world is on holiday, the trading volume today will be thin, maybe 30 to 40% of normal Friday volume. Now, thin volume is a double-edged sword. Usually, banks love thin volume. It allows them to crash the price with very little money. They can sell a few hundred contracts and push the price down $2 because there are no buyers on the other side to absorb the selling pressure. That is what they want to do this morning. They want to use the holiday silence to smash silver back down to $70 or even $68 and break your spirit before the weekend. But here's the trap. Thin volume works both ways. If a large buyer steps in, say a sovereign wealth fund that doesn't celebrate Christmas or a massive family office or a coordinated group of disciplined retail buyers, and starts buying aggressively, there is no liquidity wall to stop them. Usually, London provides that wall. London sells into the rally to slow the momentum and cap the price. But London is gone today. If we get a spark this morning, if we get a move above $73.50, there is no resistance. There's nothing between $73.50 and $78 except air. The price could gap from $73 to $76 in minutes. It would be like pushing a car on ice. Once it starts moving, it doesn't stop until it hits something solid. And right now, there's nothing solid between here and $80. Picture this. It's 9:30 a.m. Eastern. The equity market's open and the volume floodgates open. JP Morgan's head trader is sitting alone at his desk. His screen shows silver at $72.15. London's screen is dark. No bids, no offers, just black. His phone rings. It's the risk manager. We need you to keep it under $75. Do whatever it takes. He starts selling 200 contracts. Price drops to $71.80. Good. He exhales. But then at 9:47 a.m., a buy order hits. 500 contracts from Shanghai. The price jumps to $73.20. He sells another 300 contracts. Price drops to $72.90. His heart is racing now. Another buy, 800 contracts. Price $74.10. He looks at his phone. He wants to call London for backup. But the screen shows London LBMA closed. He's alone, and the buyers are circling. That's the reality of today's session. So what do? Here's the playbook for the next 6 hours. Scenario 1, the morning fakeout, 50% probability. JP Morgan knows they are vulnerable. They might try a shock and awe attack right at the open. Do not panic. This is an illusion. They're trying to trigger your stop losses because they desperately need to buy your shares cheap to cover their shorts. If you see red at the open, smile. It's a desperation play. It means they are terrified of what's coming at 10 a.m. or 11 a.m. when the real buyers show up. Scenario 2, the breakout, 40% probability. Watch the level $73.50. This is the technical resistance and the psychological line. If we cross $73.50 before noon Eastern time, the trap is sprung. Without London to sell into the rally, the algorithms will panic. Delta hedging will kick in automatically. We could see a gap to $76 or $78 very quickly, possibly in under 20 minutes. If that happens, the financial media will blame low liquidity due to holidays. They will call it a glitch. They will say it's not real price discovery. They will lie. The truth is, the vacuum's sealed, and JP Morgan got sucked in. Scenario 3, the grind, 10% probability. We chop sideways all day between $71 and $73. Nobody wins, nobody loses. The war continues Monday. Honestly, I don't think this happens. The tension is too high. The arbitrage gap is too wide. Shanghai is bidding too aggressively. Something breaks today. My final warning for today, do not trade leverage today unless you are a professional. The spreads will be wide, the moves will be violent, the algos will hunt stops. You could be 100% right on the direction and still get wiped out by a $0.50 swing that reverses in 90 seconds. If you hold physical silver, sit back, pour a drink, watch the show. You own the real thing in a world full of paper promises. You are safe. You are the bank now. If you're looking to buy, any dip below $71 is a gift from God.